Good evening, everyone. This is Dom Tavella for the Lebenthal Report. It is August 12th, 2025, and I'm usually here with my partner, Michael Horstman, who's a little bit under the weather tonight. So I have a dear friend, colleague, Tracy Burns, joining us tonight. Hi, Tracy. How are you?
I am great, Dom. Thanks for having me, and I do hope Michael feels better.
I'm sure he will. I'm sure he's going to be a little jealous because I get to hang out with you
Aw.
for an hour. But I'm really appreciate you jumping on at the last minute. And then you're our very own now here at Lebenthal. But obviously, your long background and history in the networks that you work for, this should be an easy call for you. So, if it's okay, Tracy, we'll just start with our normal format. After a really kind of rough week, the prior week, we had some pretty dismal employment numbers. We had a big recovery in the major indices. So for the week, the prior week, the S&P was up 2.4%, Dow 1.3, call it 1.4. NASDAQ just a little bit less than 4% for the week. Big recovery there. Small caps, mid cap did very well. So we had a pretty good bounce back in these markets last week, Tracy. You surprised a little bit?
I am 100% surprised, and I'm not all at the same time. I think, and we talked about this in the meeting earlier, I think there's a little bit of fatigue out there with, are the tariffs going to affect me? What am I going to do? Where's my portfolio? I think I just want to go to the beach. And so I think we're seeing a little bit of that. I think people are kind of just not even paying attention to risk. They're just doing their own thing. And it could be that summer doldrums. We are kind of in the middle of August. Semi not surprising, I think, Tom.
We with Michael, and then again, both you and I, and as a group, we have these conversations pretty regularly. But we got that bad number on the employment revision. Obviously, the Trump administration pretty upset with how those numbers were revised. But then we got some good GDP numbers as well, kind of an offset. So, where's your mindset in terms of where the economy is right now?
Yeah, so I think it's like a choose your own adventure. Like you said, GDP number was good, except that it was, the import export number that kind of carried the whole thing. We got inflation today, which one would argue was, okay. Now it didn't set off bells and whistles, but what I think it did was semi encourage the market for a rate cut in September. And then one other actual dorky tidbit is rail freight activity. And I know it's like a weird metrics, but it's one that I've looked at over the years. Rail freight activity is up in July. So we're moving stuff. I'm not sure where it's going. I'm not sure what it is. But then you have the whole flip side of you have the stagflation stories now here again. We're talking about that stagflation, right? Which is small, slow growth, persistent, pesky inflation. We're kind of there. You have, which I always look at too, increasing loan delinquencies, student loan, mortgage loans. It's all starting to pile up for people. And then that big uncertainty word is still out there. What's happening with the tariffs, with the international world, things like that. So I think you could be glass half full, you could be glass half empty. It kind of depends on, I think, what you're pouring.
Well, I think you're spot on with some of that, Tracy. You look at the economic data, and it's not terrible, right? We've talked about this for a long time. It doesn't look like we're anywhere near a recession. Yet, the economy is slowing down and we're seeing the unemployment numbers tick higher. So it is a little worrisome, but yet these markets are behaving like everything's great. Does that worry you a little bit?
I think we're totally riding the AI train, right? We talked about how 10 stocks are carrying the S&P 500 right now. Just beyond the Mag 7 or whatever you want to call them these days. So if you just have like a handful of stocks carrying everything, I think that's worrisome. What's everybody else doing? And I think at the end of the day, we have to take a holistic approach to what's going on out there and what are people thinking at the kitchen table. And I think to your point, it's tough. People are living paycheck to paycheck. People are not able to make loan payments. So on one hand, the stock market looks like it's having the time of its life. On the other hand, when you dig deep, it's not like that in households across America.
And honestly, Tracy, it's not like that in most of the stock market, right?
Well,
We look at the S&P 500, the 500 largest companies in the country, and 490 are doing okay, and
right.
doing spectacular, right? So one of the stats we saw this week that 80% of the performance of the S&P 500 is from 10 companies. The rest are, some of them are great, some of them not so great. I want to call it middle of the road, maybe reflective of the economy overall. And you mentioned the AI trade, but there's a handful literally of companies that kind of carrying the load on this one.
Yeah, so how long does that last? And it's lasted, right? Every time someone wants to hate on any kind of bull run out there, it's almost the same story, right? There's a handful of stocks carrying us. And so you have to ask yourself, do I want to take the ride and the risk, or do I want to play it safe and then have, that FOMO at the if you missed it at the end and get angry about it. And I think that's where a lot of people are right now. Do you keep throwing it into stocks like Palantir and all those guys because they're on a run, or do you just play it safe and then look back and say, I missed it? I don't know.
Well, you brought it up, Tracy. So as far as I'm concerned, you put it on a silver platter, fear of missing out. Do you
Right.
think there's still so much money sitting on the sidelines, so much money sitting in money markets? People have been kind of sitting on the sidelines waiting. Do you think some of this is people like, oh my God, I'm going to miss the boat, and they're just jumping in?
Has to be, right? I mean, it's otherwise the numbers don't make you want to wake up one day and say, I should get in this, except for the fact that I feel like I should because everyone else is. Because your cab driver is talking about Palantir and CoreWeave and names that you never heard of before. And you brought it up this morning. It has like a weird, very com bubble feel to it. And that didn't end great. Do I think it's going to, erupt like that? No, not at all. But it is feeling frothy, I guess. That was a big word back then, too.
It was a big word, and unfortunately, we lived through it, and we saw the pain that came out of it. I don't quite put this in the same category because at least we're going to focus on just generally this core group of large tech stocks. They do have real earnings, real sales, but and I'm allowed to use the word wonky once a show. They are trading at very high multiples, and in our world, that's I think an over 28 multiple, which is means they're expensive. So yeah, their earnings are pretty good, and it looks like they're going to continue growing and maybe at a pretty good clip here. But by every matrix that we use in our business, they kind of are on the expensive side.
I think too, Dom, and I don't know if it's just because we're aging with our clients, but I feel like people have a little experience behind them. I haven't had a lot of people say, "I need you to put all my money into CoreWeave, Circle, and Planetaire," right? I haven't had that. I've had much more. It's okay. I know. Let's do it right and get through this together. So I do think there's more of that out there, less of the let's chase it. And I don't know, again, if it's because our client base it has matured along with us and kind of gets it a little bit, or maybe it's just not screaming like it did back in the dot-com days.
Well, I would argue it's a combination of all those, right, Tracy? We as a firm, we're not speculative. We're not going to sit there and throw darts against the wall.
Right.
For our clients, what comes first, the chicken or the egg? Our clients are not going to be speculative, but nonetheless, it's kind of hard sometimes looking at these indexes every day, hitting new all-time highs, and going, "Oh my God, I can't believe where these stock prices have gone." But the average stock, and I bring this up occasionally, equal weighted S&P, where we're looking at the index, where every single stock, every 500 is measured equally. It's had a nice year, but not blow away numbers. So I think that's a more honest way to measure how and the way these markets are behaving.
Right, right. To take a step back, look at the big picture. You can't just carve out this one group. I mean, God bless that they're doing great, but big picture, you know, slow and steady wins the race every time. So I get that.
And we are approaching our break here, but any volatility expected over the next month or so? Tracy, what do you have to say?
Do you remember in August that wasn't volatile, Dom?
we seasonally are going into that time. I always say it doesn't usually snow in August. Usually you're going to get it in February, but we'll see what happens over the next 30, 60 days. But this is a perfect point for us to stop. We have a terrific guest tonight. We'll introduce him at the end of the break. We're looking forward to picking his brains and his insights. So when we take a break right now, Tracy, we'll come back with our new guest, James Macy. Welcome, everybody. I'm here with my good friend Tracy Burns and our guest this evening. James, I'm going to apologize for reading it, but it's a mouthful, and I want to make sure I don't screw it up. James Macy is a senior investment strategist for BNY Investments. In his role, Mr. Macy is responsible for outcome-oriented investment solutions, risk management, portfolio construction, manager due diligence, and macroeconomic research. Wow. I'm glad we have you tonight because I think we could take advantage of some of your insights. So welcome aboard.
Thank you. Happy to be here.
So I'm gonna jump right into it. I hate to put you on the spot, but we got I would say a pretty important inflation number today. I think it surprised the markets. I didn't think the number was dramatically better or worse than what the markets were anticipating, but somehow the market really read the tea leaves in a positive way. So the ball is yours. Tell us your opinion on the subject.
Yeah, great point. And first of all, thanks for having me. Second of all, it's always good to have conversations with clients when equity markets are at all-time highs. Feels a little bit different than some of the conversations we were having back in March and April, and we can certainly talk about volatility and emotions and behavioral finance and FOMO and all of that. So you are correct. The CPI did come in at 2.7%, pretty much as expected. The core level was at the highest level in 2 years, and you're absolutely correct. The market anticipated this not being a hotter number very positively. So we saw equities rally, and we're at the all-time highs now in the S&P and the Nasdaq. And particularly if you now look to essentially what the market really was taking from the CPI number is that the market expects now with a very high level of certainty a rate cut. and not even a 25 basis points, but possibly even a 50 basis point rate cut. When you actually look into some of the breakdown within the CPI basket, some of the areas are kind of frothy. I think we all, for the most part, have eggs on our breakfast table up 16%, coffee up 14%, ground beef 11%. And we were talking, I think, on the before the call earlier, Dominic, just about the average American and some of the things that they have on their breakfast table, right? So a lot of these items people actually care about, and there was very few areas within the actual CPI basket that were negative, right? College textbooks up 12%, motor vehicle repair 11%. So there was a lot of areas that are up quite a lot, and these are the things that we really care about. However, as a basket, relatively low. We're not quite at that 2% target, but the market certainly interprets that 2.7% as enough justification now for the Fed to cut in its September 16th and 17th meeting.
So we've been talking a lot about this, is the gathering of data to create this number. Do you factor that into your determination as well? I mean, do you feel like there's a justification for it? And Dominic posed this question this morning. Does the underlying economy warrant a rate cut?
That's a good question. So again, thinking about the Fed's dual mandate that they have, right? So employment is slowing, but in pretty good shape. The economy is in fairly good shape. However, growth is slowing somewhat. And stagflation has been a phrase that has been discussed on various calls that I've been having as a concern to clients, which is slowing growth and inflation. So I think we can probably all agree that the economy, the market is in fairly good shape, right? I'm fortunate enough in my role to travel quite a bit, and I can tell you that even with higher hotel and airline prices, a lot of the hotels and planes that I travel on are fairly full. And then the restaurants that we tend to eat at with our clients, higher end restaurants, are full. So, and I think that there's probably just a bifurcation right now between wealthy individuals, and those wealthy individuals really don't care about mortgage rates and borrowing costs and inflation. They're probably sitting on a lot of cash and probably are happy with inflation sort of like pushing the overall equity market up. But I think that the inflation really is affecting some of those weaker individuals, right? Those weaker borrowers are going to be much more sensitive to inflation than wealthier individuals, right? And those folks really do care. They care if a dollar is getting put onto their eggs and their milk, and they're also more impacted by higher borrowing costs than wealthier individuals as well. So the 10-year part of the curve is something that really needs to come down to just let some slack off the economy. With the number that we got today not being hotter, that could lead the Fed now to take some of the political pressure that it's been getting and actually say, okay, well, let's translate some of this data that we don't have runaway inflation, that the economy is maybe slowing a little bit. Is there a 90% probability of a rate cut, which is really what the market is expecting in September? Last week when we were having conversations around this topic, we were probably in the camp more of a 50% probability of some sort of rate cut, because we think that inflation is moderating to some degree. And we can talk about tariffs, but again, I think the fears that there would be runaway and rampant inflation because of tariffs seem to have been off the table. Inflation is sort of in line with where it was before those expectations. And is the economy slowing enough now that the Fed actually has reason to make some sort of move in September? What I would say is that if the Fed does a 25 basis point, if you think about what mathematically that means to the markets, right? The rate markets, the markets that are tied to the front end of the curve. And by the way, there is oftentimes a misconception about the 10-year part of the curve versus the front end of the curve. The Fed is really controlling the front end of the curve. If it does a 25 basis point cut, that does not necessarily translate to any meaningful move on the long end of the curve. However, with the numbers that we are seeing now, there is absolutely reason for the Fed to now sort of lean towards more of a rate cut, given that inflation has not run out of control like many in the market were expecting due to tariffs earlier this year.
Well, you certainly James can argue that we haven't seen a real significant flow through because of tariffs, but yet you brought it up. If we look at some of the underlying data on the inflation numbers, we are seeing some continued increased costs buried in there. Right now, we have the offset energy price have dropped dramatically, and that kind of sheltered some of those higher costs in some of the sectors that you mentioned. But isn't this Fed really caught between a rock and a hard place? There's still some pretty significant underlying inflation buried in there.
There is, and I mean, I gave some of the examples, right? So the average person, I'm not a coffee drinker. I drink tea. I don't know what the tea inflation is, but certainly people don't like paying more for those essentials, right? So the milk, bread, eggs, coffee, gasoline. But talking about gasoline, groceries and gasoline prices actually went down for the month. They were down 0.1% and 2.2% respectively on a monthly basis. So it's not all gloom and doom. And also the underlying weightings of those individual factors were relatively small. So that's the individual sort of food line items and some of those college expenses that I mentioned. It is important to note that the Fed does not solely look at the CPI numbers. They look at what's called the PCE, Personal Consumption Expenditures Index, which tends to run a little bit lower just in terms of the way that index is constructed. CPI is essentially a more of a fixed basket, whereas the PCE really reflects on what is happening in more real time. So it's more sensitive in terms of movements in the underlying basket weightings, and then also the movements. So is the Fed stuck between a rock and a hard place? Possibly, but it's had long enough where it's been on hold. A wait and see, data dependent effort. Clearly, it's under pressure from the current administration from that standpoint. However, the Fed is data dependent, and if they can make the case more clearly that the economy is slowing and maybe forward-looking prices are actually coming down, and the labor market is potentially suffering, that is where that 25 basis points can come in handy. As I mentioned, mathematically, a 25 basis point cut really doesn't do much in terms of the overall borrowing costs. It has more of a psychological impact. And I think what the market would take from a 25 basis point is that the Fed is now back on a cutting environment. They're not looking to do a 25 basis point and done. 25 basis point then opens up the floodgates to further rate cuts. And that's obviously going to be very good for risk assets, as we've seen after the CPI report today.
I totally agree with you. I think this is all about psychology. You mentioned behavioral science, right? People just want to cut. They almost don't even know why they want it anymore. Because you mentioned the baby boomers, the older generation that are sitting on a ton of money. That steak dinner you had, that steak was probably $125. It can go to 135, 150. People are still going to buy, that generation is still going to buy it. So it's
Yeah.
very hard to tame inflation on some level. If you have this class of people that are still going to go out there, they're going to complain. I'm going to call out my parents. All they do is complain about prices, but all they do is spend money on them anyway. So you will still have that. So I'm with Dom a little. I think it is a little bit of
Yeah.
a rock and a hard place, because how do you tame inflation when you have people willing to put their hands in their pockets all the time?
Mm. Yeah, and that's a great point as well. And they're willing to put their hands in the pocket because what's $10 more on the steak
Right.
dinner, which tastes really good. But also you made the point of there's significant assets in money markets. I mean, you can see the amount of assets in money markets just continue to go up and up and up. And something that we've been talking about with clients really before COVID and afterwards is the wealth effect. And if you think about your clients and their sources of wealth, the biggest source of wealth that most people have is two things: their housing, their house prices, which are at pretty high levels. There's pockets obviously that have come down, but house price is quite high. And then it's their stocks, it's their brokerage, their 401ks, their IRAs. And for the most part, those are at record high levels as well. So people are more wealthy because of those two things. And they feel more wealthy, and they're more likely to go out and spend. I mean, I hear stories, you know, Uber drivers, for example, talking about in dollars, I made $5,000 today or $50,000 today in my 401k, right? So that translates into, and by the way, it's you haven't made it. It's unrealized at the end of the day, right? But if people are continuing making money and looking on the screen and seeing that green, and markets going up and up and up, they will continue thinking that the market is going to continue going higher, and therefore the $10 on stake relative to the gains that they make on a daily, weekly, monthly, year-to-date basis is insignificant to them.
So, James, we had a pretty strong revision to the employment numbers about a week and a half ago, and obviously this administration was reacted pretty aggressively. But it happened during the Biden administration. Let's start with that, where we watched 800,000 jobs disappear magically. Were you guys surprised by that jobs number? And what does it foretell about where the economy is and the likelihood of a recession?
We were surprised by it. And at the end of the day, we are as data dependent as the Fed. So a lot of the econometric models and forecasts that we have relies on the data that is at our disposal. We have very broad data sets that we look at. However, we do look at those job numbers that you mentioned about. So it did take us by surprise. Historically, that there can be, we've seen this before, there can be revisions. Obviously, the current administration was not particularly happy with those with the revisions as large as they were, and you mentioned the magnitude of that number. So again, changes that were made on at the BLS in terms of just the overall oversight and sort of what is happening over there going forward. But as we just talked about, when it comes to the Fed being in a rock and a hard place, this actually gives credence to the employment situation perhaps being a little bit weaker than we thought previously, based on those sort of older and stale numbers. They've obviously since been revised downward, and that can now say, well, is the labor market actually a little bit weaker for whatever reason than we thought it was previously? So again, the Fed is obviously looking at the unemployment situation, and if those numbers actually tend to be revised, that could be the sort of ammunition that the Fed needs to actually make the case for just a 25 basis point cut in this September meeting.
I agree with you completely. How do you feel about the data, though? I mean, Brian Moynihan from Bank of America came out recently and said, how do we trust these numbers? We're not taking into account the whole gig economy at all. We don't know who's driving an Uber at night and working full time during the day. That's not reflected in the numbers. How do you feel about that going forward? I mean, how do you make a judgment call based on the semi-funky numbers right now?
Yeah, and essentially, we never believe in just looking at headline numbers, right? So again, if you were to look at the CPI number today, the 2.7%, met expectations. So if it met, then the market really shouldn't have reacted. It's what's beneath the numbers as well. So we spend a lot of time looking beneath the headline numbers around, just the broader employment and unemployment numbers. So again, if you look at the number of folks that have two jobs or part-time workers, that is where you can obviously see there's a lot of people out there now that are taking second jobs. So again, you mentioned about Uber drivers or working in restaurants, for example. So it goes back to what I was saying, the point I was making earlier on, that there are cracks that have been in the economy since probably before COVID that continue to widen and exacerbate. And I think that when we talk about the cost of things, right? Food, energy, that is disproportionately affecting some of those weaker individuals that are maybe now forced to take those two jobs. So we don't look at data just from a face value. We look beneath the surface. And as I said, there is a bifurcation, a widening of the disparity between wealthy individuals and weaker individuals. And that's why interest rates really, particularly the long end of the curve, really need to come down just to create a little bit of slack in the economy that should just let off some steam and just give those weaker sort of households some room to breathe. I think AI is one component. I don't think that's what's driving some of the weakness in some of those weaker individuals. I think it's really just a broad based, but prices have to come down. When prices come down and inflation obviously moderates, rates come down, that is going to be a plus to the economy. So again, I think that's what we were really seeing with the market reaction today. The markets had a pretty good day. The equity markets now back, you know, all-time high type of levels, because they think that they just see the now the Fed has an easier path of explaining a 25 basis point than it had previously.
So, James, we find that probably one of our best sources of data is literally speaking to our own clients. So, we've heard now for months that basically we're primarily in the small business community and kind of a hiring freeze, not really mass layoffs or anything like that, but in terms of hiring, definitely freeze, wait and see. What are you hearing from your own clients?
Yeah, absolutely. And we have a cross section of clients. So in the world that I mainly play, financial advisors, wirehouses, intermediates, RIAs, I ask this question all the time just because I'm interested, and I'm also interested in um, what your clients essentially are saying as well. But one of the questions I ask is, where are some of your biggest clients' sources of wealth? And a lot of the time, the answers that I get are, my biggest clients are, self-made small business owners. And so we talk very often, and again, I'm blessed with traveling across the country, and the small business owners and sources of wealth is very different in Chicago versus Houston and maybe Fresno, California, right? Which is obviously more agriculturally based. So there's differences in what our clients say to us based on the geography in terms of where that money comes from. I'm always interested in, tell us about are you guys hiring? Are tariffs affecting your businesses or not? And what are your plans, and where are the sort of roadblocks? I think that tariffs have affected some of our clients in some ways. But again, markets have helped a lot of those clients because they have significant amounts of their money in the stock market. I think that higher borrowing costs tend to, as I said, be disproportionately affecting weaker individuals, whether it's individuals, weaker borrowers, and smaller companies in particular, right? Small cap companies in particular tend to have a higher cost of capital. So when I'm talking about the psychological impact of a 25 basis point cut and the beginning of a rate cutting type of cycle, that is obviously going to reduce a lot of the pressure that those smaller companies have from a borrowing perspective. If they're borrowing money, then they have to add on that additional spread to their borrowing costs. So higher interest rates probably going to be affecting them. And those companies, if they foresee that rates are going to stay higher and it's going to be tight for them, probably going to be less likely to hire individuals and small businesses. At the end of the day, it is the backbone of the US economy. It's incredibly important for the US economy that those small businesses continue. But again, translating the sort of economic stuff that I've talked about with what I'm hearing from clients is probably very similar to your clients, which is, what do you guys think about AI? And that translates into how much NVIDIA should I buy? And we can talk all day about Mag 7 and the S&P 500 and the concentration there. But it's very interesting that when I think about conversations that I was having with clients back in sort of May and April of this year, when when all the headlines that we could see were so negative around tariffs and the world was ending and the markets were sort of going down. When I was sort of talking to clients last year and the year before and the year before that, just around the overall amount of complacency in the markets, and that you need to be very careful with what type of securities that you own in what type of sectors and then what type of funds or ETFs. And there is a lot of market psychology, and the market oscillates between greed and fear. And I would tell you that the conversations that we're having with clients were almost very politically loaded. From the standpoint of tariffs are going to lead to runaway inflation, and the economy is falling off a cliff to everything is fine. So what I think clients that we have, maybe on the right or the left, what really everyone cares about is either making more money or not losing money. And I think that this has been a perfect textbook example of, let's revisit that plan that you have and the time horizon, because you told me that you had a 10-year time horizon. Why do you care about a 5% move in stocks in an individual week? So it does come back to that. Warren Buffett, if you have a long time horizon, maybe slow and steady is the right way for some clients, and for younger or more aggressive clients, and maybe that is the sort of classic like small business owner or that has made money from taking risk, or engineers that really are okay with the volatility of some of those names. That is very different from someone that is approaching retirement, and also the any gain that you have is all paper gain until you sell it. It's unrealized. So you haven't made it until you sell it. And if you've made money, that's great. And let's have a conversation, but now from those high flying asset classes, maybe to something that's focusing more on protection and quality going forward.
So, James, that's a perfect opportunity for us to take a quick break, and then we'll pick it up right from there. I'm sure Tracy would love to jump along that one and ask you a bunch of questions. So, why don't we take a few minute break here, and we'll come right back and pick this up.
Okay, it's great to be back. James Macy's our guest. Dom Tavella is with us. James, you said so much before the break, but I'm gonna give you one big overriding question with all that. What keeps you up at night?
What keeps me up at night? Complacency and those behavioral traits that I talked about previously. So um, I'm fascinated by behavioral finance, and I talk to clients and ask a lot of questions normally when I meet a financial advisor for the first time, just so I can understand the psychology and where they're coming from. But there is a lot of psychology in investing and what clients care about. So I tend to be more of a conservative type of investor, so I always have to check myself. But when I find a client that I'm talking to that shows the sort of classic cognitive dissonance, which is they have a view and they ignore all of the information that is thrown at them that is contrary to their hypothesis, their view. That is probably what I am concerned about the most. And I think that there is up until maybe the sell-off that we had in March and April, there was a lot of complacency in the market that I saw, meaning that everyone was on the same trade. There was a rotation out of some of that growth name into more of that pure value type of exposure. International equities have done fairly well from it. So some of those other areas that we have talking to clients for several years, it's finally working. Diversification is finally working. And I sort of see that the market is going back into that greed type of mentality and the performance chasing. So that's probably what I'm most concerned about right now. And we talked earlier, but just about some of the multiples on some of the names and just the overall markets. This time is different. That's the argument, right? That AI, the companies are becoming more efficient, and therefore maybe the valuations that are afforded or given to some of those names are different. But what I worry about is hearing stories. I mean, I'll give you this example, but I met with a financial advisor who had a client that was in a couple of trades and made 60% in those investments over about a 2 month period. And he was asking me, what I thought about those individual areas. So my immediate response was, you made 60% in 2 months. You should be extremely happy, capital gains aside. Um, Lock that in. And again, I think the advisor really wanted me to say as well, I think it's going to continue, and those are great companies, go continue putting money in. Those are the areas that I think you need to be a little bit careful. Um, and then the complete opposite of that, greed and FOMO, was what happened in March and April, where there was complete panic. And we were kind of the opinion, well, this is going to cause some turnover, some turmoil. There will be some volatility. However, sometimes when you have these market pullbacks, they tend to be the best opportunities to get in. And then finally, we actually have a meaningful drawdown in the S&P 500. I think the max drawdown from peak to trough this year was about 19%. And we hadn't had an average drawdown in the S&P 500 since 2022. So I find it interesting because the last 2 calendar years, when I sort of said, well, we haven't seen an average sell-off in the S&P 500. That kind of concerns me a little bit, and everyone's on the same trade. And then markets sell off really to catch up with the historical average. So kind of what went up the most ended up coming down the most in that March and April, and the Mag 7 names. And so we were speaking to a lot of clients that were panicking and wanted to sell all of their equities. So it's interesting that you have to try to navigate that, but it is very much dependent on the individuals. But I think that's what makes the role of the financial advisor so important, because the clients that financial advisors have, we're all emotional, and I think that volatility just does weird things to people, and it just plays into our emotions, right? And if you think about um, all of those things that cause that market volatility, and those really, really painful days where we're having 10% moves and hundreds of billions of dollars of market cap moves in individual names in single days. And yet we've all probably forgotten about it right now. So I think the role of the financial advisor is really important, is to try to strip out the emotions that your individual clients may have. And if you have the financial plan and it's realistic and achievable, that's great. And maybe with the market kind of melting up ever higher, maybe it is a time to actually take profits and rotate some of those assets into areas that have been out of favor. And those areas specifically would be value, international, maybe some emerging market equities. And let's not forget the role of fixed income, because most of the conversations I have with clients and my team tend to be around equities and Max 7 and growth and value and international, when there's a whole other part of a portfolio that needs to continue to exist, which is fixed income. And I think that as long as the equity piece does okay, people don't really think about the fixed income case. But I think when March and April of this year happened, and equities, there was very, very few places to hide out. I think fixed income was called into question a little bit because of that more positive correlation. We would say now, with rates elevated, this actually is a good entry point to add to some of those fixed income positions. But I think for us, whether it's equities or fixed income, quality is the style of investing that we like the most, because there's a ton of stuff that's going on. There's a ton of headline risk. The best thing is probably to turn off the TV, ignore it, trust you guys as financial advisors. But I just think that you can't go wrong in periods of uncertainty. And I probably have used the word uncertainty several times, that there's a lot of unknowns and uncertainties that are out there. You can't go wrong with equities with strong balance sheets, strong cash flows, and with fixed income, with spreads being quite tight. The emphasis really is mainly on investment grade, high quality US fixed income exposure, and high quality global fixed income exposure as the buffer to some of those equities in the event that the markets become choppy again.
So, James, you brought up one particular sector I'd love to hear your thoughts on, and that's the international trade, emerging markets. After a decade of basically underperforming, they're having a pretty good year this year. Are you worried at all that the tariff, even if we're starting to kind of cement where these countries are going to be, are you worried at all that the tariff is going to kind of really ding the profits of these companies?
I think the answer to that is it depends on the type of companies that we're talking about. And remember, tariffs can also affect US companies because it depends on whether companies are exporting or importing. So if you're a US company that is importing the raw ingredients to build their widgets, that's probably going to hurt them more than a US company that is basically sourcing those products in the US. So I don't think that tariffs is really about US versus certain countries overseas necessarily. You do need to be careful about some particular countries when it comes to tariffs. But I would say that the thesis that we probably have is that there was a lot of headline sort of that were coming out with very, very high numbers around tariffs. A lot of that has been walked back, and as quickly as those tariffs appeared, they could also disappear. We would probably think that, tariffs and trade wars doesn't really benefit any particular country. It probably impacts the US less than certain other areas of the world. And when it comes to China, Europe in particular is probably going to be more affected by China and higher prices there. Europe is a very big trading partner with China. We are too. There's winners and there's losers, and we think that you need to be careful. Stock selection is something that we think is probably paramount. And look at companies and from the bottom up, look at the revenues, the expectations, but also do think about another driver of the outperformance that we've seen with international equities, whether they be emerging or developed, has been what's happened with the US dollar. So the US dollar is down about 9% year to date, and there could be room for the US dollar to continue to depreciate. We think that a good way to play international markets with lower risk is global fixed income hedged to the US dollar. Most of the time, we see international funds and ETFs that our clients hold that are unhedged to the dollar. So that's been a great tailwind for those investments. If there's a reversion back, it's obviously going to hurt them. And in the event of a continued depreciation of the US dollar, that would serve to help them. And I think being unhedged in equities is okay. Where you have to be a little bit more careful is with movements that we've seen in the US dollar is fixed income, because in that environment, that could wipe out easily a year's worth of performance. So we tend to have conversations with clients that a really good way to get international diversification is through hedged global bonds. Hedge the dollar, you have a bigger opportunity set when you take out one of those risks. And I find it fascinating because, again, going back to that market psychology, we have talked about international equities and emerging market equities and just areas of the market that were out of favor for 2 calendar years. And I would say that anecdotally, we had very little interest relative to the US markets that we also cover. Very little interest from clients on international equities. Now we seem to have much more interest because, again, that behavioral FOMO, now you have that positive performance, and the international markets have outperformed the US, right, for the first time in a long time. That's generating a lot of questions. So the main point I would make is, if you have benefited from that, and the same thing with if you have clients investing in individual companies at their peaks, and you're buying something and have missed out on that performance, it's very difficult. Then it's very different from having the investment over a longer period of time and now being exposed to that and benefiting from that market.
Isn't so much of that an escape from the US, an escape, people misinterpret it, I would say, right? And think, well, if I put my money overseas, I'm going to escape whatever turmoil is happening in DC right now, whatever mess, quote unquote, mess they're making. So I'm going to put my money overseas and I'll be safe. I think that goes back to your behavioral science point, doesn't it?
Yeah, I think there is a lot of that as well. And there I think there's some political reasons for that as well. But again, moving, and this is why I think you have to try to translate the emotions between some of that political sentiment that we see, polarization and so on, to actual investments. And it has served to benefit clients that have decided to move out of the US. When it comes to diversification, like I'll pivot from that to talk about diversification, right? Because if you think about, and I'm not sure if your clients own S&P 500 ETFs, but S&P is obviously a cheap way to get exposure to big companies, right? However, the S&P 500 is very highly skewed towards a small number of names, and they've helped for 2 calendar years. 2022 wasn't a great year for the S&P 500. And then obviously when the market was selling off in March and April of this year, it wasn't a good place to be. So we think a better way of diversifying, if you want to diversify away from some of that Mag 7 growthy stuff or the S&P, a really easy way to do that is through large cap value. Um, because value is now coming back into favor and has been. It started to come back into favor last year. But really, the S&P and some of those growthy funds and ETFs that we come across do have those big weightings towards a small number of names. So I would probably say, well, you probably want to own some of those names in your portfolio or all of those Mag 7 names. But like what I care about on my team is we work with financial advisors on sort of the relative allocations between different sectors, and then with underneath that, the type of funds and ETFs vehicles that an advisor will use. What I care more about is really the other stuff in the portfolio, which can be international and it can be emerging markets or value, small caps, fixed income. Because what I really want to see is I want to see the other stuff in the portfolio acting differently, which is correlation. And if everything is acting like the Mag 7 and that growthy type of names, what's the point of owning it? And that's the conversation that's been difficult, I think, for a couple of years because diversification really hasn't been something of interest to clients. But those clients that have been in international markets this year and have been in value this year are very happy. And even a day like today with the small caps, right? Small caps had a nice little risk on bounce. The point is that you really have to be in those areas, but you probably want to own a little bit of some of those areas if you have clients that have that FOMO. Okay, well, let's have a conversation about owning some of that stuff that's up a ton. We don't want to put all of your money in those areas because obviously, if you are happy with a 10% move up in a day or a week, you have to be okay with a 10% move down in a day or a week. And I think that was what we were experiencing in March and April of this year. It was that, wow, these companies can go down 10% in a single day. Yeah, but they were up 10% in a day and you were okay with it. So you have to be okay with the volatility inherent in some of those names because it can work on the upside as well as the downside.
So you mentioned small caps and they had a fabulous day today and finally maybe off the floor. Obviously, they're very interest rate sensitive companies. They tend to be net borrowers. Does that continue now? Are we finally at a stage where mid caps and small caps can participate, not just, as you mentioned, these large mega companies?
We're still fairly cautious around small caps in particular. There's a lot of small caps that just don't generate any profit. So we would probably say if you're going to be invested in small cap US companies, you probably want to be with an active manager rather than a passive vehicle. When you're in a passive ETF, you're obviously just owning everything in the index, and there's a lot of names in the Russell 2000 small caps that just don't generate any money. So if you're going to be there, you probably want to be active. I haven't heard of anything that's really making us want to dip our toes into small caps right now. Because it would be considered to add risk into a portfolio, obviously moving from, let's say, US large cap companies into those smaller cap names. So what that trade really is about is it's more of a risk on type of trade. I think you have to be a little bit careful thinking about adding risk into a portfolio at this juncture. If the Fed miraculously embarks on a massive cutting process, that's probably going to be the time. Will you miss some of the upside? That's okay. But again, there is a psychological element to that. Would you rather be early to add risk in the portfolio, knowing that you can experience a drawdown? Or would you rather be late to that trade, knowing that you can miss some of the upside? And the answer is probably going to be different for different investors. We probably would say lean into US large cap companies, strong balance sheets, strong income statements, and then balance between growth and value. So if you're going to be growth, be quality growth. If you're going to be value, be quality value. Same thing for international. In the models that we run, we have been quite heavily allocated to international. It has been a pain point for us. International is obviously not done as well relative to the US. We're happy with the performance that we've got. We just don't think that the environment is conducive right now to add risk, particularly when you have some parabolic moves in even within some of those some growthy areas. So we would probably say if you really want to add risk into a portfolio at the moment, emerging market equity is probably one way to do it, and it kind of goes in this order that we like US first, and then probably emerging market equities if you want to add some risk, and then followed by international developed after that. The same thing would apply on the fixed income side. I think we're still relatively cautious around adding credit risk. And what I say credit risk, I mean non-investment grade risk, high yield. We're not at that point right now. But I think when it's clear that the economy has got through this period of uncertainty and there is some slack that's built in from the Fed cutting rates, that is probably the time that we were going to start adding to small caps and adding non-investment grade credit risk into our fixed income sleeves.
I know we have like 30 seconds. So if you had to name your top 3 sectors in the US other than the AI trade, what would it be right now?
Ooh, probably healthcare, financials, and energy within the US. Large cap, diversified companies, again, strong balance sheets, and companies that are able to pass on the higher costs of things to consumers. So again, inflation not necessarily a bad thing if you're able to pass along some of those costs to underlying consumers. That is a nice natural inflation hedge.
Well, I think we're getting very close to running out of time, and I feel like we have another 43 questions. So maybe we'll save them and have you back if you would be so kind to join us. But can't thank you enough for joining us and giving us your insights this evening. I think it genuinely is helpful. Tracy, really appreciate you joining us at the last minute and adding your insights. And pretty much want to thank everybody for joining us this evening, and have a great day, evening, week. And we'll talk to you next week. Hopefully, Mike will be back on board with us and be able to continue the conversation. Thanks all. Good night.